Hi, my name is Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about the TFSA Maximizer and why you need to be aware of this. And it's not just the TFSA Maximizer, but a lot of tax schemes, tax kind of loopholes that are out there that people try and play with. And you're going to get caught, and you can get caught really bad with big fines and penalties. So I just want to walk through that today. Before I jump into the content, I just want to give you a quick update on my niece. So my niece had neuroblastoma. She's been in the Calgary Children's Hospital. And why I bring this up is a lot of you have reached out to me, and I got an email yesterday from Children's Hospital in Calgary saying that they had financial support from some of you, which is mind-blowing to me. So thank you for those of you that financially supported, prayed for her, just thought of her, whatever it was that you did. I do appreciate it. She went through surgery a couple weeks ago. She had her one kidney removed, and she had her tumor removed, but she's doing much better. She's back home. She actually started back in preschool here yesterday, so she's doing much better. So I just want to say a quick thank you to all of you that again, financially supported or supported her in any other way that you did. So thank you. So for about 8 months or so, I've had constantly people reaching out to me asking about the TFSA Maximizer. And TFSA Maximizer at a very high level is, how do we get money out of your RSP tax-free into your TFSA? And that's really the concept. It's much more detailed than that. There's a few videos. If you just search it on YouTube, TFSA Maximizer, you'll watch some videos. And I just want to bring to light that CRA Canada.ca website has a warning against this process. And I always say that it's not just the TFSA Maximizer, it's any investment solution. If you look at an investment and say, this doesn't seem right, or the rate of return seems really high, we've had a lot of clients walk through our door and hire us to put a financial plan together. And part of that process is we'll sit down and look at the investments and make sure they line up with the plan. And it's amazing how many people we see have investments. They say, I'm getting 15, 20, 25% return on an annual basis. And we look at the underlying investment, and there's definitely a lot of risk. In fact, we had a client not too long ago, shortly before we delivered their plan, they reached out and said, hey, bad news. We had about $350,000 of investment in a real estate corporation go sideways, and that money's now gone. So please adjust the plan. Now, that is awful news. Luckily, they were in a position where they could still retire on time, but definitely with way less money, less income, that kind of thing. So I think what the purpose of today is, if you get involved in an investment that seems too good to be true, you need to take a step back and do more research. There's a lot of great investments out there, but there's also a lot of bad investments. Even the TFSA Maximizer, when it first got brought to my attention, someone emailed me and said, hey, what do you think about this concept? I'm a financial advisor. I worked in the mutual fund, the sales, the investment piece. I kind of understand this industry, what options are out there. And as soon as I watched the video, I said, this doesn't make sense, and it's way too complicated. I hardly understand it. I'm in the industry. But the idea of moving money from your RSP to your TFSA on a tax-free basis, it just sounds too good. I want to be involved in that. Of course, I want to get my money out of my RSP tax-free. If it seems too good to be true, it probably is. And the TFSA Maximizer is definitely one of those things. So I'll put a link below to the Canada.ca ruling or bulletin on this. So they say, what are tax schemes? And they call it a tax scheme, which is important. It's that's a pretty strong word coming from the CRA. So they say tax schemes are plans and arrangements that are contrary to the requirements of the Income Tax Act. They recruit taxpayers by promising to reduce the taxes they owe. Schemes may promise large deductions or tax-free income. And that's exactly what the TFSA Maximizer does. So a TFSA Maximizer is something where they create a MIC, Mortgage Investment Corporation. I talked about a MIC a couple weeks ago, and this is very different. So this is a MIC that only loans to scheme participants. So you have to be part of the scheme to participate in this MIC. And they basically break it into two shares. So your MIC is broken into one paying dividends at a low rate and the other paying at a much higher rate. So the idea here is the participant buys low dividend shares of the MIC in the RSP and high dividend shares in the TFSA. From there, the MIC lends the share proceeds back to the participant, to you, the scheme participant, in the form of a first and a second mortgage loan, secured by, guess what, your principal resident. And the TFSA balance and bearing interest at rates corresponding to dividend rates on the two classes. The participant invests in loan proceeds with the promoter and earns taxable investment income. The participant makes annual RSP and RIF withdrawals and claims fully offsetting interest deduction. And this is where it kind of goes sideways. After several years of participating in this scheme, the participant is supposedly able to shift the entire RSP over to the TFSA. Now, obviously, this isn't the case. So how does the tax advantage apply to this situation? And this is really where you have to be careful. The tax advantage can be very punitive, and it can hit you not just with taxes that you should have been paid, but penalties and interest and all that. And why this is a big red flag to me is because a lot of people that have reached out to me about the TFSA Maximizer are also people that are very close to or in retirement. To me, the worst thing, and I told everyone that reached out to me on this or other investments too, is if it's not approved by CRA, so let's say you participate in it for 5 or 7 years, and at that point, CRA comes back and says, whoa, you can't do that. You owe us this much in tax and penalties and fees and interest and all this. And you're 5 years into retirement. You're going back to work. Your retirement's changed, you're selling your house, you're doing a lot of things that you definitely don't want to be doing in retirement. So how does the tax advantage apply to this situation? So they go through the promoters of TFSA Maximizer schemes claim that the high interest rate paid on the second MIC loan is normal for second residential mortgages, and explains that the corresponding high dividend rate on the second class of MIC shares. In reality, however, the entire arrangement is commercially unreasonable. The lender's actual credit risk is low because the borrowers are wealthy participants in the scheme who are unlikely to default on the mortgage, which is absolutely true. Moreover, the second high interest mortgage is secured both by the participant's residence and by the growing TFSA balance. So it's a secured loan. So you can't have this high interest rate on the loan if it's fully secured by a residence and an investment. It doesn't line up at all. Under these circumstances, the high rate of interest on the second mortgage and the high dividend rate on the second class of shares are not justified, as the participants are essentially borrowing for themselves. As a result, the increase in the value of the TFSA would be considered an advantage subject to 100% advantage tax. In addition, the interest paid on the MIC loan may not be fully deductible. So very important to understand that doing this, again, not CRA approved, could create a lot of issues, maybe now, but maybe down the road. And that's my biggest concern. Look, if CRA slaps you on the hand now, you pay penalty, interest, all that kind of stuff, you can kind of work through it. It's hard, but you can work through it. To me, it's down the road. It's 5, 10, whatever years down the road. Again, a tax scheme can be called back at any time. A lot of people say, well, after 7 years, I'm free and clear. There's a lot of case law out there on tax schemes being called many years down the road. Be aware of that. Don't let it derail your financial plan and your retirement. So again, the TFSA Maximizer is just one of these tax schemes that are out there. There's lots. I mean, just search tax schemes Canada. There's always people looking to kind of skirt, find solutions to skirt the rules. And when they find it, like the TFSA Maximizer, they market it and then they bring in clients and they make fees off that. But again, if it seems too good to be true, or if the investment rate of return seems way too high guaranteed, that's a red flag. You need to do more homework. See if it's approved by CRA. See the background, the company, all that. Again, we just had that client that lost a lot of money on a bad investment. So what can you do on your end? Do a review of your current portfolio, the investments that you're in. Are they safe? Are they secure? Are they doing what you're hoping they should be doing? But also, do they follow the risk pattern that you want to follow going forward? And if they don't, it's time to make some changes. So hopefully this helps. Hopefully this helps save you some money, some fees, some interest, and a big headache down the road in retirement. Thanks for joining us today. We'll see you in the next video.